By early 2026, global trade is entering a period of severe physical risk. As naval patrols navigate the high-friction corridors of the Strait of Hormuz, 20% of the world's oil supply is effectively under threat. This energy shock has pushed gasoline prices toward $4.50 a gallon, yet Bitcoin's price chart is behaving unexpectedly. Despite dropping 50% from its 2025 peak, the asset is repeatedly finding support near the $60,000 level. Beneath the surface of this price gridlock is a structural anomaly. The network has now gone 1,256 days without a recorded on-chain capitulation signal. Bitcoin is trapped between a historic global supply shock and the silent accumulation of institutional capital. This standoff is forcing a reevaluation of whether the historical 4-year cycle still dictates the market's rhythm. Historically, Bitcoin bear markets followed a clear script: an 80% drawdown triggered by a systemic collapse. In 2014, it was the Mt. Gox hack. In 2022, it was the insolvency of FTX. Analysts track these cycles using net unrealized profit and loss, or NUPL. This metric measures the difference between current market value and the price at which coins last moved, effectively mapping the network's aggregate paper losses. During the 2015 and 2022 bottoms, this indicator plunged deep into the negative zone. This signaled that the average holder was underwater, leading to the mass retail surrender that historically marked the end of the crash. In the current 2026 market, the data is diverging. Despite the massive drawdown and rising inflation, this indicator has stayed above the zero line. The traditional signal of retail despair is nowhere to be found. This suggests that the mechanisms driving market bottoms are changing. The absence of a panic signal indicates that the current holder base is processing this drawdown differently than in previous cycles. The market is currently pinned by two massive forces. In the Middle East, the maritime blockade has disrupted global energy supplies, creating supply chain friction that has kept U.S. inflation at 4.2%. In response, Federal Reserve Chairman Kevin Warsh has maintained high interest rates to cool the economy. This policy keeps bond yields elevated, raising the opportunity cost of holding digital assets and dampening retail demand. Countering this pressure is a new institutional floor. Wall Street ETFs, led by BlackRock and Fidelity, have absorbed over 1 million Bitcoin, providing a source of structural demand that didn't exist in previous cycles. This standoff between restrictive monetary policy and institutional hoarding means the next move depends on which of three distinct paths the macro environment takes. The first path is the macro escape. If a diplomatic resolution reopens the Strait of Hormuz, oil prices would likely fall, allowing the Federal Reserve to cut interest rates and increase market liquidity. In this scenario, massive fresh capital flows from asset managers like Vanguard would meet a highly illiquid on-chain supply. This would likely trigger a short squeeze, pushing Bitcoin out of its current range toward new highs. The second path is the institutional grind. Here, inflation remains sticky, forcing the Fed to keep rates steady, while institutional inflows from pension funds provide a slow, continuous trickle of capital. The result is a multi-month sideways chop between $58,000 and $68,000. This acts as a period of accumulation, where coins are steadily transferred from impatient sellers to institutional custodians. The third path is the black swan. An escalation of the maritime blockade could spike oil to $150 a barrel, forcing the Federal Reserve into further interest rate hikes to combat stagflation. This would likely force a major treasury liquidation. If the price breaks the $54,000 realized price floor, the average cost basis of the network, it could trigger a cascade of stop losses, pushing the market toward the $40,000 range. Across all three scenarios, the influence of retail sentiment has diminished. Bitcoin's direction is now primarily determined by central bank liquidity and professional capital flows. As institutional custody now accounts for millions of Bitcoin, the asset's price action is becoming more closely tied to professional capital allocations than to retail speculation. This shift is visible in the market's volatility. The historical 4-year cycle continues, but its swings are being compressed. The 80% drawdowns of the past have been replaced by a shallower 50% correction, stabilized by institutional appetite. Navigating this environment requires looking past calendar-based predictions. Success now depends on tracking the data points where geopolitical events directly impact the network's cost basis. By monitoring the relationship between investor buy-in prices and realized profitability, participants can identify value by watching the specific metrics that now drive the market.